Okay, let's go ahead and get started. Thank you all for joining us today as we learn more about the CARES Act and how to navigate a volatile market. It's great to have so many of you joining us today. We have a large group. We have over 200 registered for the webcast, so I appreciate all of you tuning in today. A few housekeeping rules or items before we get started. Please feel free to submit questions. You can do this by using the Q&A button at the bottom of your screen. We will do our best to get them answered throughout the presentation. We ask, I think everybody's on mute, but we ask if you would keep yourself on mute most of the time. This will help keep down on the background noise. Also, if you would like to turn off your video and your settings at the bottom of your screen, that is perfectly fine as well. Excuse me. My name is Zaida Banassi. I am a member of the class of 1985, and I serve as Director of Alumni Engagement for Regional and Campus Programs. In the midst of these challenging times, we're looking for ways to connect with one another and spend some time together. So thank you again for joining us today. I want to welcome our wonderful panelists. We have Peter Lazaroff, a class of 2007. We are very fortunate to having Peter joining us today. Peter is Co-Chief Investment Officer at Plancorp, which manages over $4 billion in retirement plans across 44 states. Thank you for being here today, Peter. Also, we have Eric Motika. Eric serves as Director of Legacy and Estate Planning at DePauw. Before we get started, I wanted to start with a quick poll question to see how everyone is feeling regarding the current market. So let me bring the poll up. Excuse me. How concerned are you regarding the current volatile market? Very concerned, somewhat concerned, not concerned at all, or neutral? We'll give it a few minutes for those who would like to complete the poll. So far, somewhat concerned is on the rise here. Thank you for your participation. Looks like most of the folks are feeling somewhat concerned. We will address some of these concerns regarding the market today. Here, I'll share the results.
Oh, wow. Okay.
And with that, I would like to hand it over to Eric to formally introduce our speaker, Peter.
All right, thank you, Zaida. So, hey, Peter, nice to see you again. We've had the chance to speak quite a bit over the past few years. And so I know you fairly well, but before we kind of get started with this, I was wondering if you could take just 2 or 3 minutes, maybe explain kind of the backdrop of your career, what led you to this point at Plancorp for everybody that's on with us.
Yeah, sure. Good to see you, Eric, and thanks again for having me.
Yeah.
So I graduated from DePauw in 2007 and went right into the wealth management business as a stock analyst. And so most of my career at the first early stages was predicated on individual stock research and sector research and making buy and sell recommendations and helping individual clients, retirement plans, institutional accounts implement some of those recommendations. About 5 years ago, I moved to Plancorp, and Plancorp is headquartered in St. Louis. We have clients in 44 states. We serve about 1,400 families, and then a number of institutions, again, both on the endowment side and retirement plan side, but what totals up to be a little bit over $4 billion in assets under management. And when I came to Plancorp, I was working as a wealth manager at that point. I'd transitioned several years prior to that from analyst to wealth manager that was helping individuals with their finances. And when I came to Plancorp, it was to take on a leadership role that has ultimately become Chief Investment Officer. And what that really means, I oversee the investment committee. We set the policy, we communicate the policy. I also oversee our portfolio management team, which implements a lot of this recommendations and policies and strategies. And then the other piece is just educating both internally and externally. That's advisors and clients. I write for the Wall Street Journal. I write for Forbes. I do some TV stuff now and again, locally and nationally. And then last year, I had my first book come out called Making Money Simple. And I've been spending the entire quarantine begging my publisher to discount that book. And they finally did on Friday, maybe for a week. I was hoping it was going to be during the whole quarantine, but I am, for those interested, dropping a link into the chat for people to use if they want to go check that out. I literally argued with my publisher for 6 or 7 weeks. So hopefully they'll like that some people are actually attracted to a book that's not $30. So it's on sale for, I think, less than $5 electronically and $16 hard copy. But that's the real fast and dirty version of my career arc to hear today.
Right, that's wonderful. And just for everybody out there, we would hope that this can be somewhat organic. We do have a number of questions that we can get to that I've put together that we will be asking Peter. But at the same time, if there are any burning questions out there in the audience, please do feel free to, toss them into the Q&A at any time. We're here for you. We're not here for us. As much as this is fun for us talking, we want to make sure that we're answering all of your questions as well. And so Peter, I did read your book on Sunday, finished it yesterday. And it was on sale. So enjoyed that thoroughly. Have a couple questions later on regarding it that hopefully you can kind of get into. But kind of in the spirit of what this is all about, this is about talking about the CARES Act, which is really new, and also really an unprecedented volatile market that we've seen happen over the course of a very short period of time. Pretty unprecedented. But to kind of start things off, I was wondering if you could take a few minutes, not to get too much into the weeds, but when you think about the CARES Act and all of the things that are in that, it's a huge bill. Covers things from treatment of RMDs, charitable deductions, 401k loans, forbearance on federally backed mortgages, you name it. There's a lot of stuff in there. But from your perspective, and kind of what you're hearing from your clients, what you're sharing with the households over at Plancorp, what would be one of the 2 to 3 top things you're really sharing with people that you would like people to be thinking about related to the CARES Act?
Sure. Well, I think one that we were really emphasizing right when it came out was changes to tax deadlines. Now, I assume that if you didn't know about that and you're joining this call, you probably already filed your taxes and you don't mind. And if you didn't file your taxes, it's probably because you already knew that. So that was probably one of the bigger little pieces there. But I do think one interesting caveat for people to keep in mind is the way that charitable gifts are, how the changes to those deductions work. So usually there's a limit on your cash gifts. And oftentimes we encourage people to gift securities, whether that's individual investments or mutual funds or ETFs to any charities. But because the market's down, that's not exactly the best time to do so. And so more of our clients are probably gifting cash this year, and there's no limit to how much you can deduct. You can deduct up to 100% of your adjustable gross income as opposed to only 50%. And then I think the charitable change that has impacted a lot of people who aren't making huge gifts is if you were taking the standard deduction, which is most people now, you didn't get any tax benefit from your charitable gifts, but now you can deduct up to $300 of charitable giving, even if you're taking the standard deduction. So that's one of the big ones. If you're in retirement, required minimum distributions have been waived. So that's a way to manage your tax bill a little bit. It also applies if you've inherited an IRA of some sort and you're normally forced to take money out of your IRA, which increases your ordinary income. And this is a big deal if it's an inherited IRA and you're working and already have income. Sometimes those IRAs push you into a different tax bracket. And there's also some ability to take money out early without that 10% penalty. You'd still owe tax on it. But from the individual perspective, that's probably one of the bigger ones. For business owners, and I won't go as deep on this just because it's hard to know if people are interested in the business side or the personal side, but I think the employee retention credits, the deferred payroll tax payments, there's been some relaxed business interests and excess business loan and operating loss limitations. So there are some things, if you're a business owner, to take advantage. But I think anytime you pass large legislation, there's always going to be opportunities for tax planning and estate planning. And I think we had the Secure Act, which was different, passed in December, and that already was giving us a lot of good opportunities to minimize taxes, both in the current year as well as in future years. But this CARES Act just kind of adds another layer to that, where I'm a big believer that you should pay your full tax bill to the IRS, but there is no reason you should be leaving them a tip. And so how can you kind of find these ways to minimize taxes today as well as in the future? And whether you're 30 or 40 or 50 or 60 or 70, there are usually things you can be doing. And right now, with both the market down and this legislation, it does make a lot of tax planning techniques a lot more attractive.
Okay. Okay. Do you foresee a lot of people taking advantage of the kind of the RMD holiday?
I think so. I think, well, so let me put this into some context. A lot of our retirees, when they're taking RMDs, they're not living off of them. They're often finding ways to minimize RMDs because they have plenty of taxable assets, or they have plenty of funds or income coming from different places, where being forced to take those distributions and recognize ordinary income is a negative. And maybe they're minimizing those leading up to the point where they're required to take them out. Sometimes people will just give them straight to charity in something called a qualified charitable distribution, so that they don't have to realize the income. But for the most part, I think most people are taking a holiday, unless, taking this holiday on the RMDs, on the required minimum distributions, unless they were planning to live off of that money. It's just oftentimes you can sell something in a taxable account at the capital gains rate, which is often lower than the ordinary income tax rate that you would apply to an RMD. So in general, yes, we are seeing a lot of people take a break from these. Also very, very, very true on inherited IRAs when the person already has a current income. But in that, sometimes we see people doing more Roth conversions. So when you convert a normal IRA into a Roth IRA, you owe ordinary income taxes on the gains, as well as any sort of contribution you made that was deductible. And so, with asset prices depressed, if I was planning on giving 1,000 shares of XYZ, because it equaled $100,000, so I was planning to convert that to a Roth instead of 1,000 shares, maybe I'm converting 2,000 shares worth that same amount. So when it recovers, you've kind of maximized that change for a lesser amount of money. So it's really been an interesting time, and the Secure Act made Roth conversions extremely attractive relative to, they were already attractive for a lot of different people. They just became more so in December, and again with the market fall and the CARES Act as well.
Okay, great. And I guess for those who don't need it to live off of, this could be an opportunity for them to allow their IRAs to rebound. And we saw a pretty significant drop in March, so this can allow them to, over the course of 2021. When does it come back into play? Is it 2022?
Yeah, so right now it's saying, and I have a note on this, that you would next year have to take them. But I would suppose that if we are in this situation next year, if people have not returned to somewhere, without jumping super far ahead in wherever conversation could go, if the economy is operating at 80% capacity still 1 year from now or in December, it's reasonable to think that they would continue to pass legislative measures that would allow people to have more control over their finances.
Okay, you mentioned kind of depressed stocks, and that people don't really want to be giving stock at this point because the market has dropped quite a bit. That kind of leads me into another thought, which is really just the volatility of the market. It's been significant. You go back to 2008 and look at what happened during those years. We kind of almost repeated that in the course of 2 to 3 months. It was quite amazing what has actually happened. And so with that said, I have friends and people I've kind of heard just talking randomly about different things, that now might be like a really great time to go pick up some shares that might be on sale. I've even heard of people talking about playing the swing trade, trying to do short-term gains over the next month to 2 months, a few weeks or so. What are your thoughts on that from a really high level? If somebody is looking to do that, to take advantage of a kind of a market that's been beat up, what would be your recommendations for how somebody really should approach that?
Sure.
Yeah, just run with that one. Yeah.
Well, so let me, before answering, give a little context to what my answer is going to be. Market losses are incredibly normal. Most years we have a double-digit decline. From we had a 10-year run with, there was a 3-year period where we didn't have a 10% decline. That was incredibly unusual, and we were coming out of an incredibly low volatility period of time. And so the two to 3 weeks in which the market dropped about 35%, that was very volatile. Everything since then actually quite normal. It's just been a while since we've had the swings in the market back and forth. And so, if you've only been an investor for a decade of your life, this probably seems pretty scary. If you've been an investor for 3 decades, it might still feel scary, but for different reasons. And so I think a lot of times, one of the things in my role, when the market's down 10%, which on average happens about once a year, we send out an email to clients and it's like, hey, this is normal, stay the course. When you react in the near term, like oftentimes the biggest gains come after the biggest losses, like reacting ends up hurting performance. Rather than look at your portfolio, look at the inputs of your financial plan first. Like try to find other things to do, try to rebalance, try to excess harvest. And when I send this, people know that I'm willing to say candidly, those emails make me upset because my feeling has always been, wake me up when we're down 30%. Because when we're down 30%, one, you are in a bear market, but two, it's really been a historically very good entry point to the market. It doesn't mean that once you're down 30%, you couldn't fall further. So as you mentioned in the last recession, from October 2007 to March 2009, the S&P 500 was down nearly 60%. So over let's just make round number 60% over 18 months. It's a little bit different time period, but here we went down 35% in a matter of a couple of weeks. And had you entered at 30%, you're probably pretty happy because we bounced up quite a bit. Could we go back and retest those lows? Of course we could. And when we all return back to work, could the virus, spike up again and cause people to shut down? Of course it could. But the stock market is a forward-looking mechanism. And so when you buy stocks, think of it, you're just giving company capital to run their business. And if you think of it less as in the aggregate and you think of it as just like one company, think of it as just McDonald's or whatever. When you're a provider of financial capital, you are buying the future cash flows. And so in those weeks when the market was falling precipitously, people were incorporating the new information and trying to say, hey, we know there's not going to be earnings this quarter. We know earnings are just like, it's a total throwaway. And maybe the next quarter, but now, as you've seen the rebound, markets can see out and say, yeah, I can see profits again. Are they going to be coming from different places? Yes. Will they be lower than they were at the peak? Yeah, probably. But as long as the market can look forward to future earnings, that gives you hope that, maybe this recovery has some footing. That said, so you asked, if you're looking to be opportunistic today, I'd argue as part of a disciplined investment plan, if you're routinely depositing money every month, every quarter, every paycheck, every year, whatever, yeah, it's a great time to buy. Prices are lower than they were before. I personally always find it, I saved to my 401k, I saved to an HSA, to IRAs, to taxable accounts, and those are automatic savings. I don't even think about it. They just go in. I don't have to time the market. There's really no ability to time when the right time to get in is. However, when the market was down 30%, I started moving money from my emergency fund into my brokerage account, thinking, okay, now this is interesting because even if we go down another 25, 30%, the pain is already, a lot of the pain has already happened. And so if you enter today, the odds are, there's an 80% chance in any given point in history that you go out 1 year further and the market's going to be up. And in something as probabilistic as investing, all you can take with an uncertain future is probability. It's the only way to make a rational decision in light of complete unknowns and uncertainty. And so today is probably just as good of an entry point as it was last week. Is it as good as it was 3 or 4 weeks ago? No, but that's okay too. If you're investing, to answer your question, for like a short-term gain, historically that just hasn't worked out for people, particularly individuals, but even advisors. There's probably 2 or 3 groups that have historically done it. And it's not just short-term, and they don't really even allow outside investors. So even the biggest investment groups, even the biggest endowments in the world, even sovereign wealth funds, they are not capable of making short-term gains. If it were that easy, everybody would do it. I think the thought experiment often comes to mind is like, how much money are you willing to spend to know if you're good at trading? And the answer is, it's whenever you give up, whenever you realize, oh, I'm not as good. And I think one of the flaws with a lot of trading platforms, and definitely with Wall Street, who encourages you to do it on your own, is it's hard to track performance in the correct way. Most people just remember whether they're up and down. They look at the total value of their portfolio, but they don't have a way to measure time-weighted returns, which is really the standard in investment performance measurement. And so, I generally encourage people, if you're putting money to work, hopefully you have an investment plan and you're sticking to that plan. I would say I personally prioritize employer retirement plans before elsewhere. So if you aren't maxing out that account, that's a good tax sheltered way to grow your wealth. It's also a good way to grow your wealth in a way that there's some guardrails there. You can't just buy whatever you want. You probably have a slew of index funds, and maybe you have some other funds available, and but you buy a target date fund. There's just a lot of ways to behaviorally make a good decision inside a retirement plan, which is typically why I say that. And HSAs are usually my next favorite place to go because there's kind of a triple tax benefit. You get a tax deduction on the way in, it grows tax deferred, and then you take it out tax free. So that's a pretty good place, and then go to taxable accounts after that.
Yeah, I'm really glad you said that, because the reason I asked that question is because you hear a lot of chatter during times like this, especially depending on who you're listening to. If you're listening to Bloomberg or CNBC, Jim Cramer, whoever you're kind of looking at to get guidance. And there's a lot of, it can be a lot of excitement around certain things happening in the market where people think they can time it and
sure.
Effectively.
Well, those guys, their job is to get you to watch them. And if all they did was, hey guys, stay the course and commercial break for 2 hours, nobody would watch them. And I think they should be disclosed. They should have to disclose like what's in their personal portfolio. So Jim Cramer's a famous example of his record is atrocious, but he does publicly disclose his charitable account, his donor advised fund, and it doesn't do that well either. But he has gone on record being like, he just owns a portfolio of index funds. He doesn't really, for his personal wealth, he doesn't change it much. And so oftentimes you hear people, even like huge hedge fund managers, those who've been wildly successful, and they will rail on a certain point about whether the market's undervalued or overvalued or a certain sector. But here's the problem is then the camera turns off and you don't know if they walk over to the computer and sell the position right then. So a lot of times it's hard to like capture what is the motives of these people who are telling you different things. And I think the more you can remember that the financial media is in the entertainment business, the better off you are. And as someone who's done CNBC, they don't routinely call on me because oftentimes they want you to say something crazy. And I think the last time, you'll have to go onto YouTube to look for, the last time I went on to CNBC, they asked me a question, or trying to get me to say something. And I'm like, that's just not a relevant question. And, I said it multiple times, so they just kept asking it different ways. And the fact of the matter is that, the timing of all this is not nearly as important as your time in the market. And most investing success comes down to just minimizing mistakes and allowing your portfolio to grow. And these losses that we have, they're temporary unless you sell, and they are the cost of higher returns. It would be great if we could all just save cash and meet our goals and outpace inflation. But look, we don't earn anything on our cash. And even historically, when interest rates were higher, cash usually trailed inflation, if not just barely meeting it. So you have to take some risk in order to grow your money faster enough. Otherwise, you have to save like 90% of your income to have any shot of this working out for you. So the average returns that we always talk about, they are hard to achieve. They involve really painful periods. The more you know that in advance, I think the more it helps. It's also why a lot of people shouldn't own just stocks. They should own bonds so that volatility is dampened. And when they watch the market, say, fall 13%, they can look at their bond portfolio and say, well, at least that's up. And it gives them an opportunity to rebalance there.
Yeah, you made a couple really great points in your book that really they really stuck out as I was reading through it. You kind of mentioned that a second ago. One was, it's really timing the market versus market timing, which I think is really something great for people to understand and to learn. So if you wanted to elaborate on that, that'd be great. But also, you had another really, really great story in there. I think her name was Grace Groner. I think she worked at
yeah,
Lab.
Sure.
And if you want to take a minute to kind of share that, I think it's highly instructive. I really enjoyed it. So yeah, that'd be great if you could do that.
So yeah, let off a chapter with an anecdote. There was a story that started, I believe, in like the Chicago Tribune, and about a woman named Grace Groner, and she had passed away. Because I'm not looking at the book, I'm going to get some of the numbers wrong, but she, grew up very frugal. She was adopted, and she ultimately went to work for Abbott Labs in the early 1900s, and they paid her in Abbott stock. And she, was a good saver, and she lived in a tiny, tiny apartment in a very poor part of town. And her friends, the reports are like, she would spend money to travel, basically like only shopped at thrift shops, and one of those classic people who just like saves away, but didn't do anything interesting other than held that Abbott stock her whole life. And then when she passed away, she left I think double-digit millions to her former community college, and it provides $200,000 of scholarships per year. And so, Grace Groner, to me, what's interesting is the most important thing is she didn't make any changes. She just had one strategy, she stuck with it, and she kind of just let time take over and compounding take over. And shortly after that story, and I'll butcher this stat without looking at it, if you look at like Warren Buffett's wealth, the vast majority of his wealth, because of the way compounding works, came after he qualified for Social Security. So people always think of Buffett as one of the wealthiest men in the world, and he always has been. Well, not always, he for a long time has been, but it wasn't until like age 70 where his wealth like catapulted because of the way that compounding works out. And I think it's really, with Grace Groner, she got rich off of one stock, which is something most people shouldn't do. And so did Warren Buffett. He got rich off of one stock. If you're going to get rich off of one stock, you have to put your whole net worth into it. The research suggests that's a terrible idea because most individual stocks underperform the entire market in aggregate. And then 40% of individual stocks suffer what's called a catastrophic decline. So a permanent decline of 70% from its peak value or more, 70% or more. And so your odds of hitting it big are not as good as your odds of going broke. And in order to hit it big and become just incredibly wealthy, you basically have to concentrate such an irrational amount of your portfolio in an individual stock that it's kind of crazy. And that applies a little bit to today when you look out and several weeks ago, I don't know, Nordstrom's was 90% down off its high, and like Carnival Cruise Lines or Macy's or even Exxon, Exxon or ConocoPhillips down like 70%. And you think, well, these companies aren't going anywhere. Mm-hmm. And even though they look really attractive, and Williams-Sonoma, that was actually a really good one, a good example of one where you think that place is never going to go out of business. Everybody registers for weddings there, and like, who's going to sell me pots? The thing is that in order for it to actually change your life, you'd have to put a huge amount of your net worth in. And mm-hmm. generally for people who work at a company that pays you in stock, we try to keep your overall exposure below 10% to begin with. But to go all in on a stock is a little bit crazy. And so Grace Groner, that would probably be the one criticism, and I maybe even call it out in the book, is she got rich off of one stock, but the most important thing is that she just held on forever, and it was very simple, and she never worried about the times that the market fell throughout the Great Depression, the multiple 50% drawdowns. All of those happened, and her wealth grew at the market rate of return, and that's really impressive. And I think the sooner that you can understand how normal losses are and think of them as just the cost of the higher returns in the long run, the better off you are going to be behaviorally. Because if you interrupt compound interest, that's sort of what is going to put you in a bad place. It's maybe you try to time when to get out. You also have to try to time when you get back in, and chances are there's taxes involved. And of all the people, so because I had the good fortune of working through the financial crisis, everyone who went to cash, they were a total mess throughout the recovery. They could not figure out when to get back in, and you'd have this plan for them. They're like, well, I want to wait till it goes lower. And then it would go lower, and they're like, I'm gonna wait till it goes lower. And then it'd go up, and they're like, I missed the low point. I'm gonna wait till it goes back down. And then it didn't go back down. Mm-hmm. And it keeps going up, and they're waiting and waiting. And cash plays psychological mind games. And so when you're trying to time the market, you got to remember how markets work. I mean, we haven't even gone to that just the fact that there are millions of people in the world, and it's their collective knowledge that's setting prices. And so you may have a single viewpoint, but the chance that that's already incorporated into price is pretty near 100% certain. There's really only two edges in investing. It's having better information or being able to better interpret information. And any information, I'm willing to bet everybody on the call, myself included, does not have better information than anybody else. Because if you're reading it in the paper or online or talking to somebody in industry, that is not better information. People have satellites going. They've developed cell phone apps for people to use in certain industries just to track their data and trail on it. So the amount of information out there is staggering. And as someone who was a stock analyst, I had a really great run because most of my stock picks happened during the start of a bull market. I think I had really good fortune of learning how lucky I was and getting out of sort of that angle. I just, enough of the right books kind of got plopped in front of me, and I met enough of the right people to learn early on that the level of competition is absurd. And so trying to time these things, trying to be smarter than the market's just really, it's a loser's game. And if the key to investment success, and you ask all the greats, they all say this, is minimizing mistakes. here's an easy thing you can minimize. I mean, good investing is boring. If it's super interesting, you are definitely doing it wrong. And if you have enough wealth to entertain yourself, again, we talk often about peeling off a portion of your portfolio, 1%, 5%, whatever, depending on your wealth, that if it went to zero, it wouldn't matter. And you kind of express yourself and treat it like an expensive hobby that way. And if you win, great. And if you lose, it doesn't really impact your life.
Yeah. Real quick, I wanted to jump in. There were a couple questions here, really one's just
Sure.
for clarification. Somebody had asked what we were just talking about, were we saying kind of the differentiation between timing the market or time in the market? And I probably said those too quickly, so I apologize. And then the other one asked about the rule of 72, if you wanted to touch on that too. Does it still apply in this market?
Sure. Yeah. So I got the questions up here. This is such a nice format you guys have here. So I will say that I'm saying that time in the market is more important than timing in the market. There's just no way to time the market in and out to know. I mean, there would be Nobel Prizes won for it if it was something that could be done, but there aren't, and everybody agrees that you can't do it. So time in the market, the overall time spent is way more important than timing. Peter Lynch, who was a super successful mutual fund manager in the 80s and 70s, 80s, 90s, he had done a study to show that if you had only invested at market highs versus only invested at market lows versus only invested on the first of the year, what was the difference in returns? And there wasn't that big of a difference in returns when you just went out over a 20, 30, 40-year period. So the amount of time you spend in the market is far more impactful than the timing of your first investment. To the question, does the rule of 72 still apply to investments today? Well, the rule of 72 mathematically is still factually correct in that when you divide 72 by the rate of return that you earn, that's how often you should double your money. So if we say 72 divided by 8, that means if you have an 8% return, the rule of 72 would say that your money doubles every 9 years. However, in real life, even if the market is averaging 8% per year, it never actually earns exactly 8 every year. So the rule of 72 never actually applies in practice. It always is factually correct that 72 divided by your rate return equals the amount of time approximately to double. Mm-hmm. But it is a good back of the number way to think of it. And so I throw out 8% somewhat loosely. If you're in your 30s or 40s and you have multiple decades to retirement, plus you have multiple decades in retirement, and so you maybe have a more aggressive equity allocations, you have 70, 80, 90% stocks, an 8% return over 30, 40 years is a very reasonable assumption. So you would then ask yourself, how many doubling periods do I have left in my life? And you just look at doubles every 9 years. Does that mean it will exactly double every 9 years? No, but if you invested in March 2009, your money doubled in like 1 year. So it's kind of where you got in and recognizing, sort of that distinction. So hopefully that helps answer. And I see this other question. He's just saying he likes what I said. So I like that. It's just a good comment. They agree with me. So I always agree with people who agree with me.
That's great. Thanks for kind of cleaning some of that up and clarifying that, because I think I ran my words together. So I apologize for that. Earlier, you kind of mentioned, you talked a lot about behavior and investor behavior, individual behavior. Especially in the book, you talk about behavior related to personal financial decisions, but you also made the comment about the big mistake. I spent some time at Merrill Lynch a while back, and it was an interesting time. I learned a heck of a lot. One of the things I learned was really, the job of an advisor really, really pays for itself during a time like this, when things kind of go crazy and people don't really know, how to work through it emotionally or mentally. So what are some of the big mistakes you see, or I guess you help people avoid, a couple that you might help people avoid during a time like this to can then set them up for success in the future on the other side of this thing?
Sure. Well, I think hiring an advisor is not cheap. I think there's a large group in the advisor community who feels like, hey, we're totally worth our value, and they get upset when people talk about like charging 1% or 0.75%. But the thing is that, like 1% of your investments, that's not a cheap investment. So why would you do that? I would argue that a lot of investment advice is highly commoditized in the sense that getting a highly diversified portfolio in a reasonable asset allocation is pretty cheap. You can do that pretty cheaply now. the behavioral coaching piece is what's valuable. And I think when we charge 1% on the first $1 million, then the fee schedule drops from there pretty precipitously. That a lot of that value is from financial planning. So I think if you're paying an investment advisor to just give investment advice, that's a really poor choice personally. That had to do a lot of where I ultimately decided I wanted to work. It's why I wanted to buy into the company and become an owner. So I think if you're going to pay money, and I know your question is investment related, and I'm going to get there, but I just think that if all your advisor is doing is getting you investment advice and saying, oh yeah, like go make sure you have an estate plan. That's not financial planning. Someone who can do tax projections, someone who's reading your legal documents, someone who's like in the nitty gritty doing proactive work to minimize your tax bill. That's valuable. So that sort of helps justify the fee. But on the investment side, I think the number one value of an advisor is behavioral coach, because you can earn a lifetime of fees in a single bear market or in a single bull market, just avoiding one really bad decision. Not only is it the absolute loss that you protect someone against, but that loss compounds. So if you bail, I was on the phone nonstop with clients the first few weeks of these shelter in place orders because people wanted to get out. And you're saying, no, like this is, we tell you all the time, market drops happen. And the 10 and 20% are very normal, but the 30, 40, 50% ones, they happen a lot too. I mean, more often than once a decade. And so if you lock in that loss and the market takes off, not only if you have this opportunity cost, that opportunity cost compounds over time. And so it is a massive number. And when you have an objective third party, they're not as emotional about it. Now, a professional in any sense is going to do a better job. So I used to mow my lawn and I didn't kill my grass and it looked fine. But then I started paying someone $35 to mow my lawn and it looks awesome. And they do all these things that I never would have thought of, or even if I did know what they were, I didn't know how to do them. And I didn't want to take the time, and it's just easier. And so I think it's why you have coaches in sports. It's why you have doctors doing, I think one thing, so my parents are both physicians. And I remember when WebMD came out, my dad hated it because people would come in and be like, hey, already had diagnosed themselves. It's like, oh, I'm sure they went to 6 years of medical school too. With investing, everyone who's ever read a sentence in the Wall Street Journal has an opinion, and they challenge, financial theory, where financial theory works amazingly well in the long run. But the problem is the long run feels like an eternity in the moment. And so what is the long run? I mean, statistically speaking, it's really 20 years, but let's say it's 5 to 10 years. And I think people just, when you have an advisor whose job is constantly to be watching this stuff, to be constantly learning and not just piecemealing things together, you're gonna, a professional, anything is going to do a better job than an individual.
This question popped up. I have to read it because it's pretty into the weeds, and I apologize. I think we're almost getting near the end of the time already, but I think this is an interesting question. Can you see that on your end?
I actually can. Do you want me to read it, or do you want to read it?
I can read it.
Yeah, go ahead.
Yeah. So what do you think the current and short-term economic environment will have on defined benefit pension plans and lump sum payments, as most plan calculations are based on the 30-year treasury rate, which is now at historic lows? In other words, are you seeing those retirement age taking lump sum payouts now? That's a really well-written question. Very good. Yeah.
So there's a couple pieces here, because one is like, hey, are people taking lump sum payouts now if they're retired versus the annuity option? And it does. So I'll say that more often than not, plans are trying to make the lump sum option more attractive because companies and governments and entities, employers in general, don't want these defined benefit plans anymore. They want them to go away because they're super expensive. And if they can incentivize you to take a lump sum payment, you typically see that. Now, there are times, so in general, I think in aggregate, all else equal, we do see people taking lump sums more than like the lifetime annuity or the lifetime annuity with survivor benefit. But it isn't always the case because some people's defined benefit plans have some things that make that annuity more attractive. Now, the other piece of this is like, given the current short-term economic environment, what's the impact it'll have on defined benefit plans in general? They're gonna, if interest rates are low, I don't know how many people took accounting, but when interest rates are low, it makes the funded status typically go negative because your liability is larger. And so particularly government pensions have been dealing, state government, anything that's tied to local municipalities, those pensions have been under more pressure. I think there is a little bit more concern in this downturn than the last one, although there was a lot of concern in the last one that municipalities might have to renegotiate pensions. And I think that's definitely likely at some point. And most of our clients who are relying on a pension as part of their retirement, we do sort of, if they're 60 years old right now, we don't necessarily water down the benefit, but if they're 50, we might water it down a little with the acknowledgement that, look, it's guaranteed until there's a bankruptcy court involved and they suddenly don't have to pay out that pension the way they used to. So I would say that this is not any different than past recessions in the sense of the risk of that, but interest rates being low does put a lot of pressure, on these pension plans. But again, I think that's the 2 points. I think we got another question going into the chat room. If you're sitting in cash and relatively young and didn't have much outside of 401k and HSA, where would you start investing? Probably just depends on if you need the money. So you shouldn't invest money in stocks that you don't need for the next 5 years, just like a good rule of thumb. Your tax rate matters. Like if you have a Roth IRA available to you, you should probably do that before an HSA. But if you don't have a Roth IRA available, you should do an HSA, I think. If you have no IRA, you can always convert them to Roth. So make what you call a backdoor Roth contribution where you put money in an IRA and then you immediately convert it to a Roth. Roth IRAs are great retirement accounts. If all your retirement accounts are maxed out, there's nothing wrong with investing in taxable dollars. It just means you're a really good saver. But I think young savers, if you're under the age of 55, and I know a lot of people ages 50 to 55 will challenge me. I mean, they do to my face all the time. If you're under the age of 55, you should be rooting for market losses to invest your money at lower costs. And I think it's those years, the 3 to 5 years leading up to retirement, as well as the 3 to 5 years following the day that you retire, there's a risk that is introduced called sequence of return risk. And basically, if you're forced to withdraw your portfolio while it's down, that it permanently impairs the long-term trajectory of the income that you can get from your portfolio. And so there are some considerations there. But if you're young, boy, it's as good a time as any to be working on those. But if you think there's any chance you're going to need the money, like if you don't have job security and you don't have an emergency fund, that's actually probably a better place to start. I often emphasize an emergency fund, not at all costs above retirement savings. It really just kind of depends on your personal situation. Or if you know you're going to buy a house, or if you know you're about to start a family, that can also play a role.
Mm-hmm. Sure. Okay.
We got more questions coming, it looks like.
Oh, wow.
Can I answer them, or do you have them, Eric? Where do you want to go?
Well, this is an interesting one. Well, I did have one other. I would prefer questions coming from guests be answered over the ones that I kind of put together. Wow, these are both really good.
They're good ones.
On active versus passive management on the account level. It's very specific. Yeah,
it is specific. All right. So active versus passive. I've written a lot of articles about this, but I haven't written one in a couple of years because the very last one I wrote is that it's the wrong debate. So anything that isn't just the total world market index portfolio is active. So the second that you add bonds, you've made an active choice. The second that you vary how much US versus international you have, which if it's in a total market index portfolio is 55% US, 45% international. The second you deviate from that, you're active. The second you deviate the difference between large, mid, small, you are active. The second you introduce a passive sector ETF, which is really not even remotely passive, you're active. What the real debate is low cost versus high cost, rules-based versus forecast-based. So traditional active managers will try to pick which stocks are going to win or lose, or which bonds are going to win or lose. Whereas a rules-based systematic approach will say, and this is what index funds do. It's just a rules-based systematic approach that buys companies according to certain rules, primarily how big is their market capitalization. But there are other funds out there that quantitatively manage according to rules that also have low cost, also have low turnover, also follow rules and have no forecast whatsoever. So I think traditional active management of trying to time when to get in and out of the money, when to put certain market money to work in security selection, that's bad. I think if that's how we're defining it, just passive being just index funds, I think that index funds are just better. I do think that a lot of the factor funds or funds that emphasize certain areas of the market that have historically distributed more return, like value or quality or momentum or small, those shouldn't be ignored, but to be actively timing those would be bad. So, I mean, it's not the answer that most people want. And if I have to give a quick response, like here, I got to elaborate that anything other than the total market index is active, even if you're using index funds. If I didn't have time to give that response, I'd say, oh yeah, passive. Because again, it's about minimizing mistakes. And index funds are a wonderful innovation, and they are the right answer for a lot of people. There are ways where you can accept more risk in the form of what you'd call tracking error. So if you said, I want to own the whole market, but I want to own more value companies than growth companies systematically, and according to rules, you'll look different than the benchmark every day, every month, every quarter, every year, and you're taking more risk over time. You hope to be compensated for that risk. I would say that's a type of strategy that to me is active. People used to think of that as passive also, but I think it's active. You're just accepting different types of risk. So short answer is passive over active all day long. The long answer is basically everything's active. And it should be the debate between low cost and high cost, as well as forecast-based and rules-based systematic approaches. The other question I see is, what are the effects the election results will have on the market? Nobody knows. So that's the quick one. You've written on this. There is no tie to who is in office, whether it's in the White House, whether it's Congress, whatever mix. There's no evidence. You can look at history and see that certain things have done better and worse, but there's no evidence that any party's control makes a difference. The market doesn't really work that way. Things aren't linear in the sense that like A causes B and B causes C. Actually, DePauw has a course on something called complex adaptive systems. It's a 400-level biology course, and it is one of the most impactful kind of lessons that experienced investors could possibly have, because markets are complex, adaptive systems. There are all these interconnected inputs where if you replayed history over and over and over a million times, there would be different outcomes every single time. There's typically volatility ahead of the election, but no one ever really knows what the effects will be. Because even if you know the outcome, here's a good thought. So even if you know the outcome, it's hard to know what the market will think, because so John Maynard Keynes, so everyone who had an econ major knows of Keynesian economics, but Keynes had a thought experiment where it said, and I'm going to modify it a little for the times, but if we were to run an ad in the newspaper and put up 100 photos of men and women and tell readers that the person who picks the 6 most attractive people, as deemed by the readers, wins $1 million. The way that you would go about winning that competition isn't picking who you think is the most attractive person. You would pick who you think the average person thinks the average, or who the average person thinks is the most attractive person. That's how you'd win that contest. Now, Wall Street's really smart. Markets are really smart. They know this. So they don't pick who they think the average person thinks is the most attractive. They're going to pick who the average person thinks is the most attractive. And that's what you call second level thinking. And realistically, if you were going to know how the election results might occur, it probably wouldn't be enough to do good second order thinking. You'd probably have to go third order, and that's just hard. And people aren't good at it. And that's why active management typically has failed. Active management being the active security selection and active timing of types of investments.
I think this Leah, we're 153 right now. I think there's one last question here that I think, if you want to hit on that, that'd be great. But it's for people, and then if you have any closing thoughts, I want to leave that for you. If you have any closing thoughts you'd want to share with everybody. But for people receiving IRS stimulus checks from the CARES Act, and I don't know how to answer this question either. If anybody does, what will happen to the payments if they go uncashed or undeposited? And
I don't know, but here would be my guess, but don't hold me to it. It's probably worth going to the IRS or going to your accountant. But my guess is that there's a lot of people who have unclaimed property, and there's a website you can go to, and the government keeps track of it, and it would just go into that account. And if you don't claim it in your lifetime, then it just rolls over to the next person, and the government treats it as an interest-free loan somewhat. That would be my guess is what happens, but I honestly have no idea.
Yeah, that's an interesting question.
Go ahead and just cash those checks if you can.
That would be probably a good idea if you have one, for sure. I did want to ask, kind of as we close up, in the back of your book, you recommend some other books to people too, which I thought were great. And I've read a handful of them that you have in there. But what would be like one of my favorites is Random Walk on Wall Street, just a fantastic book. But when you're thinking about maybe like the people on the call today, it's a broad spectrum of people from multiple decades of graduating years from DePauw. So as you look at kind of a broad stroke there, what would be one or two books you would kind of highly recommend people read to help them navigate kind of what we're going through right now, so that maybe doesn't cause as much fear? Because while it is unique and different, these have happened before and they're going to happen again. We don't know what the catalyst will be, what the Black Swan event would be to make it happen. But just kind of some closing thoughts on what people might want to read to gain some more. That's what I'm looking for. I'm kind of confident.
Read my stuff.
Going through.
That's
well, exactly. No, yeah, I did.
Yeah.
I did. It was great. But I'm just kind of curious, your thoughts.
Totally makes sense. Yeah. So you'd mentioned A Random Walk Down Wall Street. So that plus there's a book called Winning the Loser's Game. Random Walk Down Wall Street's Burton Malkiel, and Winning the Loser's Game is Charlie Ellis. And they're on like the Mount Rushmore of investment thinkers. But the two of them took those books and smushed them into something called The Elements of Investing. It's very short, very digestible. The Elements of Investing is one of the most gifted books I have. I think that something like Simple Wealth, Inevitable Wealth by Nick Murray is also very powerful. You will not find it in bookstores. It is kind of expensive because he hasn't put out many copies and people keep paying for them. So, but that's a really good one for perspective. Those are more on the beginner-ish side. I do think The Little Book of Common Sense Investing from Jack Bogle is pretty good. And so, the Elements of Investing, Simple Wealth, Inevitable Wealth, Little Book of Common Sense Investing, those are really good if you are novice to intermediate, because even if you're intermediate and you know a lot, like you do forget some of these like core basics that resonate so importantly. Because again, this stuff isn't that hard. A lot of what's going to make you successful in a period like now is just minimizing mistakes and sticking to financial theory, which holds unbelievably true in the long term. If you want to like go down a more advanced path, I feel like something like Fooled by Randomness is interesting. You could go a behavioral route. I think Daniel Crosby has a number of interesting books. The most recent, and I think it's the one I put into my book, I had a hard time choosing which one, but it's called The Behavioral Investor. I think that one's pretty good. And William Bernstein, who does a nice job. Which book is it? Is it The Investor's Manifesto or is it The Principles of Investing? He has two. I think it's The Investor's Manifesto, where he kind of goes over market history, then he goes into theory, and then he goes into application. And so those can be some more like kind of intermediate and upward type titles. That's more than one or two. Sorry about that.
No, that's great. I think that's wonderful, and hopefully people can get some value out of those. And yes, I would recommend Peter's book. It's a good read. It's an easy read. It's written well, and yeah, it's fun. And it is still on sale on Amazon. So we saw those the other day. I don't know if there are any last minute questions or did you put this book list on? Oh, I think
if you Google my name and book list, you'll probably see a lot of these. I've written something in Forbes for sure, something in the Wall Street Journal, and then something on my blog, but it is in the back of my book. Oh my gosh, there are actually some really good ones I left out, like Against the Gods, which is a story about risk. I have them segmented out by, for those just getting started, for those looking to advance beyond the basics, and for those interested in a deep dive into more complex issues. I can take these books and segment them that way and put them somewhere on your website if you'd like. Okay. Or for $4.49, you can go buy the Kindle version and they're all in the back.
Good. Well, hey.
By the way, I don't make any money on royalties on these. I waived my royalties to make sure that I could buy cheap books. So when I'm pushing it for you guys to go there, I'm more trying to stick it to my publisher and tell them they should have lowered costs a while ago. So I kid a little bit. I do appreciate people who do. If you do happen to purchase the book, I'd appreciate if you leave an honest review for me. And I love to hear from people. And people can reach out to me if they have questions. I can drop my email into this chat box if that helps people ask specific questions. It's just peter@plancorp.com. Although it looked like it attached to my, here we go, to my last one. And if you want more resources, you can, I have a 9-question quiz that kind of points you to all the resources I've created based on your circumstances. Those are things that I just dropped into the chat for everybody. Smartmoneyquiz.com is a way to get a hold of a lot of the stuff that I've done.
Oh, great. Thank you. Thank
Yep.
you. And Zaida, did you have some closing comments as well, or?
Well, I just wanted to say thank you, Eric, for facilitating a great conversation. And thank you, Peter, for sharing your insights with us today. And thanks to everyone who joined us today. Our hope is that we have provided some useful information that you can take back with you as you study your own portfolios. We hope that you learned something today. Also, we hope that you can join us on May 19th for our next webcast. We will have Bobby Andrews, Vice President for Enrollment Management, who will give us an update on the current admission process and the incoming freshman class. For now, have a great rest of your day and stay safe, and hope to see you soon.
Thank you again, Peter.
Thanks,
Thanks for joining
everyone.
us.
Yeah, thanks
Really
for having me.
appreciate it. Take
See
care.
you all.
Have a great day.
Thank you.
Okay. Bye-bye.